What is investment? Investment refers to the act of allocating resources, usually money, with the expectation of generating an income or profit. Investments can take many forms, such as buying stocks, bonds, real estate, or starting a business. The goal of investing is to put money to work in a way that will grow or appreciate in value over time, allowing the investor to earn a return on their investment. Why is investment required? Investment is required for a variety of reasons. One of the main reasons is to grow personal wealth and achieve financial goals such as buying a home, saving for retirement, or paying for education. By investing, individuals can put their money to work in a way that generates a return, which can help them to reach their financial goals more quickly than simply saving money in a traditional savings account. Another reason for investment is to help businesses and economies grow. Businesses need investment capital to expand and create new jobs, and economies require investment to drive economic growth. This can be achieved through various forms such as venture capital, private equity, and crowdfunding. Overall, investment is a way to put money to work in order to achieve financial goals and help drive economic growth. What are types of investments? There are many different types of investments, but some of the most common include stocks. These are shares of ownership in a publicly traded company. When you buy a stock, you become a part owner of that company and have the potential to earn a return through dividends or an increase in the stock's value. Bonds. Bonds are debt securities issued by companies and governments. When you buy a bond, you are lending money to the issuer, who agrees to pay you interest and return your principal at a later date. Real estate. This includes investing in property through buying a property, renting it out, or investing in REIT. Mutual funds and exchange-traded funds. These are investment vehicles that pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other securities. Certificates of deposit. These are low-risk investments offered by banks and credit unions that pay a fixed interest rate for a set period of time. Savings accounts and money market funds. These are low-risk investments that offer relatively low returns but provide easy access to your money. Alternatives investments. These are investments in assets such as hedge funds, private equity, commodities, derivatives, and other non-traditional investments. These are some of the most common types of investments, but there are many others available, each with its own unique set of risks and potential returns. It's important to do your research and consider your own financial goals and risk tolerance before investing. What are types of investments in India? In India, some of the common types of investments include equity. This includes investing in stocks of Indian companies listed on stock exchanges such as the National Stock Exchange and Bombay Stock Exchange. Fixed income. This includes investing in bonds issued by the government and government-owned companies, as well as fixed deposits and public provident fund offered by banks and post offices. Real estate. This includes investing in property by buying a property or investing in real estate investment trust. Mutual funds. These are investment vehicles that pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other securities. Gold. Investing in gold can be done by buying physical gold ETFs, or sovereign gold bonds. National Pension System. This is a government-backed retirement savings scheme that allows individuals to invest in a mix of equity, bonds, and government securities. Public Provident Fund. This is a long-term savings scheme offered by the government that offers tax benefits and a fixed rate of return. Life insurance policies. This is also considered as an investment which not only provides life coverage but also helps in savings and provides tax benefits. These are some of the most common types of investments in India, but there are many others available, each with its own unique set of risks and potential returns. It's important to do your research and consider your own financial goals and risk tolerance before investing. What are types of investments in India other than above? In addition to the types of investments mentioned previously, there are some other options available in India that you may consider. Post office savings. This includes various schemes offered by India Post such as National Savings Certificate and Sukanya Samriddhi Account. Unit-linked insurance plans. These are insurance policies that offer a combination of life insurance coverage and investment in a variety of funds such as equity, debt, or balanced funds. Real estate investment trusts. REITs are trusts that invest in income-generating real estate assets such as office buildings, shopping malls, and warehouses. They are similar to mutual funds and are listed on the stock exchange. Infrastructure investment trusts. InvITs are similar to REITs and invest in income-generating infrastructure assets such as roads, power transmission lines, and airports. Commodity trading. This includes investing in commodities such as gold, silver, and crude oil through futures contracts on commodity exchanges. Cryptocurrency. Investing in cryptocurrency is still a new and emerging trend in India. but it has been gaining popularity in recent times. Foreign exchange. Investing in foreign exchange, also known as forex, is a form of speculation on the value of one currency against another. Startup investment. Investing in startups has become popular in India with the rise of the startup ecosystem. Angel investing and venture capital are the most popular forms of startup investment in India. It's important to note that many of these options carry a higher degree of risk than more traditional investments such as stocks, bonds, and mutual funds. It's important to do your research and consider your own financial goals and risk tolerance before investing. How do you explain investment to a 10-year-old? Explaining investment to a 10-year-old can be a bit tricky, but here's one way to simplify it. Investment is like planting a seed in the ground. When you plant a seed, you put a small amount of money, or a seed, into something, like a bank account, with the hope that it will grow into a bigger amount of money. Just like how a seed needs water and sunlight to grow, your money needs to be put into the right place and given time to grow. For example, you can put some of your money into a savings account, which is a little bit like planting a seed in a small pot. Your money will grow slowly, like a small plant, but it will be safe and easy to access. Another option is to put your money into a stock market, which is a little bit like planting a seed in a big field. Your money can grow a lot faster, like a big tree, but it's also a bit riskier, because the stock market can be affected by a lot of different things like companies' performance, the economy, and world events. Just like how a farmer takes care of their crops, you also have to make sure to check on your investments and make adjustments as needed. It's also important to remember that investing is a long-term game. It's not something that will give you instant results. It takes time and patience. It's important to remember that this is a simplified explanation, and there's a lot more complexity to investing. But the idea is to give a child a basic understanding of the concept of investing and how it can be beneficial in the long run. How should a 10-year-old start investing? It's great that a 10-year-old is interested in investing. However, at this age, it's important to keep in mind that investing can be risky and it's important to have adult guidance. Here are some ways a 10-year-old can start investing. Start saving. Encourage the child to start saving their pocket money, birthday money, or any other money they may receive. Encourage them to set goals for what they want to save for, such as a new toy, a trip, or a larger purchase. Open a savings account. Help the child open a savings account at a bank, and encourage them to regularly deposit money into it. A savings account is a safe and easy way to grow money over time. Learn about money. Encourage the child to learn more about money and how it works by reading books, watching videos, or playing educational games. Invest in a child's mutual fund. Child's mutual funds are special mutual funds that are specifically designed for children. These funds can be invested in with small amounts of money and usually have a low minimum investment amount. Participate in family investments. If the family has investments, involve the child in the process and explain the investments to them in simple terms. Give them a small amount of money to invest. Allow the child to experiment with a small amount of money in a simulated stock market game, or even a piggy bank stock market. This will help them understand the concept of investment without risking a lot of money. Remember, the most important thing is to educate the child about the value of money and the importance of saving and investing for the future. It's important to encourage a long-term perspective and to be patient, as the results of investment will take time to show. And most importantly, it's always a good idea to have adult guidance and supervision when it comes to handling money. What are types of investments in India that a 10-year-old can do? As a 10-year-old, there are a few types of investments in India that you can consider. Saving. Encourage the child to start saving their pocket money, birthday money, or any other money they may receive. Encourage them to set goals for what they want to save for, such as a new toy, a trip, or a larger purchase. Open a savings account. Help the child open a savings account at a bank, and encourage them to regularly deposit money into it. A savings account is a safe and easy way to grow money over time. Child's mutual fund. Child's mutual funds are special mutual funds that are specifically designed for children. These funds can be invested in with small amounts of money and usually have a low minimum investment amount. Participate in family investments. If the family has investments, involve the child in the process and explain the investments to them in simple terms. Give them a small amount of money to invest. Allow the child to experiment with a small amount of money in a simulated stock market game, or even a piggy bank stock market. This will help them understand the concept of investment without risking a lot of money. It's important to remember that these options are relatively low risk and the returns may not be high, but the idea is to teach them the value of saving and investing at an early age. As they grow older and have more money to invest, they can consider other options such as stocks, bonds, and mutual funds, but always with adult guidance. What is the equity investment in India? Equity investment in India refers to investing in stocks of Indian companies that are listed on stock exchanges such as the National Stock Exchange and Bombay Stock Exchange. When you buy a stock, you become a shareholder of that company and have the potential to earn a return through dividends or an increase in the stock's value. When you buy a stock, you are buying a small piece of ownership in the company. When the company earns a profit, you can earn a share of that profit in the form of dividends. And if the company's value increases, so does the value of your stock. Equity investments are considered to be higher risk than fixed income investments such as bonds, but they also have the potential for higher returns. Indian equity market is considered to be relatively high growth market. However, it is important to note that investing in the stock market involves risk, and it's important to do your research and consider your own financial goals and risk tolerance before investing. Which one is better in India? Equity investment of mutual fund investment. The choice between equity investment and mutual fund investment in India depends on your individual financial goals and risk tolerance. Equity investment in India refers to investing in stocks of Indian companies that are listed on stock exchanges such as the National Stock Exchange and Bombay Stock Exchange. When you buy a stock, you become a shareholder of that company and have the potential to earn a return through dividends or an increase in the stock's value. Equity investments can be considered to be higher risk than fixed income investments such as bonds, but they also have the potential for higher returns. On the other hand, mutual funds in India are investment vehicles that pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other securities. These funds are managed by professional fund managers who invest the money into a variety of securities. Mutual funds are considered to be less risky than direct equity investment, and they offer the benefit of diversification. Both equity investment and mutual fund investment have their own set of advantages and disadvantages. Direct equity investment allows you to pick and choose your own stocks, which can be rewarding, but it also requires more time and research. Mutual funds, on the other hand, offer the benefit of diversification and professional management, but they also come with management fees and other expenses. Ultimately, the best choice for you will depend on your individual financial goals, risk tolerance, and investment horizon. It's important to do your research and consult with a financial advisor before making any investment decision. Advantages and disadvantages of equity investment and mutual fund investment. Diversification. Mutual funds invest in a variety of securities, which can help to spread risk and reduce the overall volatility of the investment. Professional management. Mutual funds are managed by professional fund managers who have the expertise and resources to research and select investments. Liquidity. Mutual fund units can be bought. What are the disadvantages of mutual fund investment? Disadvantages of mutual fund investment. Fees and expenses. Mutual funds charge management fees, administrative expenses, and other costs that can eat into returns. No control over investment decisions. Investors in a mutual fund have no control over the specific investments made by the fund. Timing risk. The value of mutual fund units can be affected by the timing of investments and redemption. If a large number of investors redeem their units at the same time, it can force the fund to sell securities at an inopportune time, potentially resulting in losses. Risk of underperformance. Mutual funds are subject to market risk, and the performance of a fund may underperform compared to the broader market or a benchmark index. Less transparency. Unlike stocks, mutual funds do not have to disclose as much information to the public, which can make it harder for investors to assess the performance and risk of a fund. It's important to remember that mutual funds, like other investments, come with risk. It's always advisable to do your own research, understand the fund's objectives, and read the fund's prospectus before investing. It's also important to consult with a financial advisor and consider your own financial goals, risk tolerance, and investment horizon before making any investment decision. A consult from us. I would recommend considering equity investment as part of your investment portfolio. The Indian equity market has been known for its high growth potential, which can provide the potential for higher returns compared to other investment options such as bonds or fixed deposits. One of the key benefits of equity investment is the potential for capital appreciation. When you invest in a company's stock, you become a shareholder, and if the company's value increases, so does the value of your stock. This can result in significant long-term growth for your investment. Another benefit of equity investment is the potential for dividends. Many companies pay dividends to their shareholders on a regular basis, which can provide a steady stream of income. This can be a great way to generate passive income for your investment portfolio. Furthermore, companies that are listed on the stock exchange are required to disclose financial information regularly, which allows investors to make informed decisions. This transparency can help you to evaluate the performance and potential of a company before investing. In addition, equity shares can be bought and sold on the stock exchange, providing investors with liquidity. This means you have the flexibility to cash out your investment whenever you need. In contrast, mutual funds are subject to market risk, and the performance of a fund may underperform compared to the broader market or a benchmark index. Additionally, mutual funds charge management fees, administrative expenses, and other costs. Potentially higher returns in equity investment with example of Vedanta stock. Potentially higher returns in equity investment refers to the potential for higher returns on your investment compared to other types of investments such as bonds or fixed deposits. For example, let's say you invest $1,000 in Vedanta Limited, which is an Indian multinational diversified natural resources company stock, and the stock price increases by 15% over the next year. This would result in a $150 capital gain, and your investment would now be worth $1,150. On the other hand, if you had invested the same amount in a fixed deposit with a 6% interest rate, you would only earn a return of $60. This example illustrates how equity investments can potentially lead to higher returns than fixed deposit. It's important to note that equity investments also come with a higher level of risk and volatility as the stock market can fluctuate. The returns of any particular stock can be affected by various factors such as industry performance, companies' financials, management performance, etc. Therefore, there is no guarantee of higher returns. But historically, the stock market has provided higher returns over the long term. Additionally, the returns can vary depending on the company, the industry, and the overall market conditions. It is always advisable to do your own research, understand the company's objectives, and read the company's financial statements before investing. It's also important to consult with a financial advisor and consider your own financial goals, risk tolerance, and investment horizon before making any investment decision. Capital appreciation in equity investment. Capital appreciation in equity investment refers to an increase in the value of an asset over time, which can be realized when the asset is sold for a higher price than the purchase price. For example, let's say you invest $1,000 in company X's stock, which is a leading Indian technology company, and over the next year the stock price increases by 20%. This means that the value of your investment has increased by $200 and your investment would now be worth $1,200. This increase in value is an example of capital appreciation. It's important to note that the stock prices of a company can fluctuate due to various reasons, such as companies' financial performance, market conditions, industry performance, and other macroeconomic factors. Therefore, capital appreciation is not guaranteed and it can vary depending on the company, the industry, and the overall market conditions. It is always advisable to do your own research, understand the company's objectives, and read the company's financial statements before investing. It's also important to consult with a financial advisor and consider your own financial goals, risk tolerance, and investment horizon before making any investment decision. Dividends in equity investment. Dividends in equity investment refers to the payments made by a company to its shareholders out of its profit. When a company earns profits, it can choose to retain a portion of those profits to invest in growth opportunities, or it can choose to pay out some or all of those profits as dividends to shareholders. For example, let's say you invest $1,000 in company X's stock and the company decides to pay out a dividend of $1 per share. As a shareholder, you would be entitled to receive $1 for every share you own, which in this case would be $1 times 1,000 shares equals $1,000. This is in addition to any potential capital gain or loss from the change in the stock price. It's important to note that not all companies pay dividends, and the amount and frequency of dividends can vary widely among different companies. Dividend-paying companies may be viewed as more stable and less risky, as they are sharing their profits with shareholders. However, it's always advisable to do your own research, understand the company's objectives, and read the company's financial statements before investing. It's also important to consult with a financial advisor and consider your own financial goals, risk tolerance, and investment horizon before making any investment decisions. Transparency in equity investments. For example, let's say you're considering investing in Company X, a leading Indian technology company. As an equity investor, you would have access to the company's financial statements such as its income statement, balance sheet, and cash flow statement, which would provide you with information on the company's revenue, expenses, profits, assets, liabilities, and cash flow. You would also have access to other financial data such as the company's quarterly earnings reports and annual reports, which would provide you with information on the company's performance over time. Additionally, you would be able to access analyst reports, research papers, and other data and information that would allow you to understand the company's business and industry, as well as its competitive landscape. This transparency allows investors to make informed decisions about whether to invest in a company, and also to monitor the company's performance over time. It's important to note that the availability of financial data may differ among companies, and that the data available may not always be complete or accurate. So it's always advisable to do your own research, understand the company's objectives, and read the company's financial statements before investing. It's also important to consult with a financial advisor and consider your own financial goals, risk tolerance, and investment horizon before making any investment decision. Liquidity in equity investments. For example, if you bought 100 shares of a stock for $10 each, and the stock price increases to $12, you can choose to sell the shares and make a $200 profit. Additionally, you can also choose to hold on to the shares if you believe the stock price will go up further. The ability to buy and sell shares of a stock on a stock exchange also means that equity investments have a much greater degree of liquidity than many other types of investments such as real estate or private business ownership. This liquidity can provide It's also important to consult with a financial advisor and consider your own financial goals, risk tolerance, and investment horizon before making any investment decisions. Explaining diversification, professional management, liquidity, and mutual fund investment with real-world example. Diversification in mutual fund investment refers to the ability to spread your investment across multiple stocks, bonds, or other types of assets. You can spread your investment across a number of different stocks, which can help reduce the overall risk of your investment. For example, let's say you invest $1,000 in a mutual fund that holds 20 different stocks. If one of those stocks experiences a significant loss, the impact on your overall investment will be less significant than if you had invested all your money in that one stock. Professional management in mutual funds refers to the fact that mutual funds are managed by professional fund managers. These managers have the expertise, knowledge, and resources to make informed investment decisions on behalf of the fund's investors. They also have the ability to continuously monitor and adjust the fund's portfolio to take advantage of market opportunities and to minimize risk. For example, let's say you invest $1,000